Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. Valuation is a crucial concept in finance and investment. It involves the process of determining the worth of a company or asset and is essential for making informed decisions about buying, selling, or holding investments. In the Little Book of Valuation, author Aswath Damodaran provides a comprehensive guide to the art and science of valuation, offering practical insights and examples to help readers understand the key concepts and methods. This video will explore the key concepts and methods presented in the book, including discounted cash flow analysis, comparable companies analysis, and precedent transactions analysis. It will also examine the importance of considering both financial and non-financial factors in valuation and the potential biases and limitations of each valuation method. So, without further ado, let's jump straight in. In the first section of the book, we explore discounted cash flow analysis. DCF analysis is a method of valuation that involves estimating future cash flows and discounting them to the present to determine the current value of the company or asset. The author notes that DCF analysis is based on the premise that the value of an asset is the sum of its future cash flows, discounted at a rate that reflects the risk of those cash flows not materialising. One of the key advantages of DCF analysis is that it provides a rigorous and systematic approach to valuation, allowing investors to estimate the intrinsic value of a company or asset based upon its expected future cash flows. This can help investors to make informed decisions about whether to buy, hold, or sell an investment. To perform a DCF analysis, investors must first estimate the future cash flows of the company or asset being valued. This can be done by forecasting the company's revenue, expenses, and capital expenditures over a period of several years. Forecasted cash flows are then discounted back to the present using a discount rate that reflects the risk of those cash flows not materialising. The discount rate used in DCF analysis is often referred to as the cost of capital and represents the rate of return required by investors to compensate them for the risk of investing in the company. The cost of capital is typically calculated using a combination of the company's cost of debt and cost of equity, weighted according to the company's capital structure between that debt and equity. DCF analysis is a powerful tool for valuation, but it also has some limitations. One of the key challenges with the method is that it requires a lot of assumptions and estimates about the future cash flows of the company. These estimates may be subject to uncertainty and volatility, making it difficult to accurately predict future cash flows. Another limitation is that it can be sensitive to the discount rate used in the analysis. Small changes in the discount rate can have a significant impact on the estimated value of the company. This means that investors must be careful to choose an appropriate discount rate that reflects the level of risk associated with the investment. In the second section of the book, we explore comparable company analysis. Comparable company analysis is a widely used method for relative valuation. It involves comparing the financial metrics of a company to those of similar companies to determine its value. The author explained that this method is based on the idea that a company's value is related to the values of other companies in its peer group. One of the key advantages of comparable company analysis is that it follows investors in comparing the value of a company to other similar companies in the market. This can help investors to identify companies that are undervalued or overvalued relative to their peers and to make more informed investment decisions. To perform a comparable company analysis, investors must first identify a group of comparable companies that operate in the same industry or sector as the company being valued. The financial metrics of these comparable companies are then analysed to determine the appropriate valuation methods to use for the company being valued. The most commonly used valuation multiples in comparable company analysis are the price to earnings ratio, the price to sales ratio, and the enterprise value to EBITDA, EV over EBITDA ratio. Once the appropriate valuation multiples have been identified, investors can calculate the implied valuation of the company being valued by applying these multiples to its financial metrics. For example, if the average PE ratio for the comparable companies is 20, and the company being valued has earnings per share of £2, the implied valuation based upon the price earnings multiple will be £40 per share. While comparable company analysis is a useful tool for relative valuation, it too has some limitations. One of the key challenges with this method is that it relies on the assumption that the comparable companies are truly similar to the company being valued in terms of their growth prospects, risk profile, and other key factors. If there are significant differences between the companies, the valuation multiples may not accurately reflect the value of the company being valued. Another limitation is that it does not take into account the unique characteristics and competitive advantages of the company being valued. This means that the method may undervalue or overvalue the company if its characteristics are significantly different from those of its peers. In the third section of the book, we explore precedent transactions analysis. Precedent transactions analysis is a method of valuation that involves analysing the sales price of similar companies or assets in the market to determine the value of the company. This method is based on the idea that the price paid for a similar company or asset can provide insight into the value of the company or asset being valued. One of the key advantages of precedent transactions analysis is that it provides a real-world valuation benchmark based on actual sales prices of similar companies. This can help investors to make more informed decisions about the value of the company. To perform a precedent transactions analysis, investors must first identify similar companies that have been sold in the past. The sale price of these companies or assets are then analysed to determine the appropriate valuation multiples to use for the company. Once the appropriate valuation multiples have been identified, investors can calculate the implied valuation of the company or asset being valued by applying these multiples to its financial metrics. For example, if the average EV over EBITDA multiple for precedent transactions is 10, and the company being valued has an EBITDA of £100 million, the implied valuation based upon the EV/EBITDA multiple would be £1 billion. Whilst looking at previous transactions is a useful tool for valuation, it too has some limitations. One of the key challenges with this method is that it relies on the assumption that the similar companies or assets are truly comparable in terms of their growth prospects, risk profile, and other key factors. If there are significant differences between the companies on these, the valuation multiples may not accurately reflect the value of the company being valued. Another limitation is that it may not provide a complete picture of the value of the company. The sale price of a company or asset may be influenced by the factors other than its intrinsic value, such as market conditions, strategic considerations, or regulatory factors. In the fourth section of the book, we explore the importance of considering both financial and non-financial factors in valuation. The author notes that while financial metrics are important for valuation, they should be viewed in the context of the company's broader business model, competitive position, and industry dynamics. One of the key non-financial factors that investors should consider is the company's competitive position. This includes factors such as the strength of its brand, the quality of its products or services, and its market share relative to competitors. A company with a strong competitive position may be more valuable than a company with similar financial metrics but a weaker position in its industry. Other non-financial factors that investors could consider include the company's growth prospects, their management team, and the regulatory environment. For example, a company with a strong management team and favourable regulatory environment may be better positioned to execute on its growth strategy and create value for its shareholders in the long term. When considering non-financial factors, it is important to use a structured and disciplined approach to analysis. This can include conducting market research, gathering data on industry trends, and engaging with industry experts and other stakeholders too. In the fifth section, the author explores the concept of valuation uncertainty and the importance of using a range of values in valuation. He notes that valuation is inherently uncertain and that it is important to consider a range of potential outcomes in order to account for this uncertainty. One way to incorporate valuation uncertainty into analysis is to use a range of values rather than a single point estimate. This can involve using a range of multiples or financial metrics to calculate a range of potential valuations for the company being valued. Another approach is to use sensitivity analysis, which involves analysing how changes in key assumptions or inputs to the valuation model affect the financial valuation. This can help investors to identify the most important drivers of valuation and to assess the potential impact of changes in market conditions or factors. In the sixth and final section, the author provides some practical tips for investors conducting valuation analysis. These include the importance of focusing on the most important drivers of valuation, using a disciplined and structured approach to analysis, and being mindful of the limitations of different valuation methods. He also notes the importance of maintaining a long-term perspective in valuation analysis. This means focusing on the fundamentals in the business and its competitive position, rather than the short-term market fluctuations or other distractions similar. Overall, the Little Book of Valuation provides a comprehensive introduction to the key concepts and methods of valuation. While the book is aimed primarily at individual investors, it is also a useful resource for professionals in the finance and investment industries. By providing a clear and accessible overview of valuation methods and their strengths and limitations, the book empowers investors to make more informed decisions about the value of the companies and assets they are considering. Whether you're a seasoned investor or just starting out, the Little Book of Valuation is a valuable resource for anyone looking to improve their understanding of valuation and make better investment decisions. And once again, that's it. Thank you for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.